Welcome to this next section on life insurance and annuities, policy replacement, and cancellation rules. Insureds or customers have a right to cancel. Individuals age 60 and over, the state of California gives everyone purchasing life insurance time to reconsider the purchase. If the policy owner is dissatisfied with the policy, he or she can return it for a full refund, no questions asked. The right of rescission for a full refund as of July 1, 2004, for persons 60 years of age or older must be 30 days or less. The extra time is protection for older Californians. The notice must be in at least 14-point font on the coverage page or policy jacket and have an open margin around it so that it can be easily found. This ruling applies to both life and annuity products sold to seniors. A senior is anyone 60 years of age or older. When dealing with life and annuity products and dealing with health and disability products, a senior is anyone 65 or older. The policy provision's free look will be referred to on your test as cancellation period, right of examination, or examination period. Individuals under 60 years of age, every policy of individual life issued and delivered shall have printed on it a notice stating that after receipt of the policy by the owner, the policy may be returned by the owner for cancellation by delivering it or mailing it to the insurer or to the agent through whom it was purchased. The period of time shall not be less than 10 days or more than 30 days for individuals less than 60 years of age. This free look provision does not apply to group life or group annuities, credit life, or policy conversions. After July 1, 2015, all annuities also have a 30-day free look. Non-variable life and annuity contracts must state, "You have purchased a life or annuity. Carefully review it for limitations. The policy may be returned within 30 days from date you received it for a full refund. After 30 days, cancellation may result in a substantial penalty known as a surrender charge." Those notices are required on all policies, and samples of those notices are in the 14 and 12-point bold type in your text, so look those over. Let's now look at the penalties for replacement of life insurance and annuity policies. When a life policy or annuity is replaced, it interrupts one that plan of insurance or annuity to begin with another one. In other words, you're stopping one from another company and starting a new one with your company. As a result, a policy owner may suffer a loss or policy benefits and a financial loss. The new life policy may have a higher premium rate based on the insured's attained age, or higher premiums based over the policy period. The annuity owner could suffer a surrender charge, and the new policy may have a longer life expectancy. The policy owner may again pay the initial cost of issuing a policy and be subject to surrender charges for a number of years. In some cases, replacement may be advisable, but every precaution must be taken to protect the consumer. Replacement is any transaction involving the sale of a new policy and the existing policy is to be lapsed, forfeited, surrendered, terminated, converted to a reduced amount, amended to effect a reduction of benefits or term of coverage, or reissued with a reduction of cash value. So that's the definition of replacement. Replacement of individual life and annuity contracts is also known as Article 8 in the Insurance Code. Its purpose was to set minimum standards of conduct, require full and clear information so the applicant can make an informed decision, reduce the opportunity for incomplete disclosures and misrepresentations, and impose penalties for failure to comply. Conservation is an insurance company's or an agent's attempt to keep the existing policy from being replaced by the policy being proposed by the other agent or company. Let's now look at the replacement requirements that do not apply to credit life, group life or annuities, exercising a contractual change or conversion, and transactions with the same insurance company. So those are not considered replacements. The agent must submit a signed statement as to whether the agent knows replacement or may be involved in a replacement. Agents sign the application, therefore this is considered a signed statement. If replacement is involved, the agent must present to the applicant a notice regarding replacement of life insurance disclosure form signed by both the applicant and the agent. The notice is left with the applicant, and a copy of this notice is submitted along with the application to the new insurance company. They must obtain with each application a list of all existing life and annuities to be replaced, and they must leave with the applicant the original or a copy of the printed communications used for presentation to the applicant. Every agent who uses written or printed communication in a conservation effort must leave with the applicant the originals of such material used. The insurance company's duties during replacement. The replacing insurance company must make sure all compliance rules are being followed. Give written notification to the other insurance company within 3 working days with the identification information and policy summary containing data on the proposed policy or annuity that will be used to replace their policy. Maintain a copy of this notice, a policy summary, the contract summary, and any ledger statement used in their records for 3 years, and extend the free look automatically to 30 days. The insurance company must require, as part of a completed application, a statement signed by the agent as to whether or not he or she knows that a replacement may be involved. If replacement is involved, they must require a list of all existing life or annuity policies to be replaced. An insurer who undertakes conservation trying to save the policy within 20 days of the date it receives the written material mentioned above must give the policyholder a policy summary for the existing policy containing the policy data. The existing insurer must also maintain evidence of policy summaries, contact summaries, or ledger statements used in any conservation effort for at least 3 years. If an agent or insurer recommends the replacement or conservation of an existing policy by use of materially inaccurate presentation or comparison of an existing contract's premiums, benefits, dividends, or values that are false, it is a violation. If an insurer or agent recommends to a senior the purchase of an unnecessary replacement policy, it's also a violation. In layman's terms, a replacement must always provide a gain for the insured rather than an even swap. In other words, if the new policy is substantially the same as the old policy and no additional benefits accrue to the insured, that's a violation. The new policy must improve their situation, provide better coverage, lower premiums, better cash value. Their situation must be substantially improved in order for the replacement to be considered legal. There are penalties. For licensees, meaning agents, the first penalty is $1,000, and thereafter the penalty will be no less than $5,000, but no more than $50,000. For insurance company, the first fine is $10,000, and thereafter the penalty is $30,000 up to $300,000. There are various requirements and guidelines having to do with a replacement, and you should review that extensive list in your text. Beware of the agent who suggests that using the cash value from your current policy to fund the premiums on a new policy offers a demonstrable advantage to you. That's often false. Beware the agent who advises you not to speak to anyone from your current insurance company about a policy replacement or change he or she is proposing. That's illegal. Beware the agent asks you to sign incomplete or blank forms. That's illegal. Or beware the agent who speaks negatively about another agent or the other insurance company. Replacement rules require a comprehensive evaluation, may indicate that replacing or changing your policy is in fact advisable. However, certain cautions are appropriate when considering replacing or changing your life insurance. You should review the guidelines in your text. They're quite extensive about what makes the replacement advisable and when it is not advisable. The bottom line is the customer must be in a better position with the new policy than they were in the prior policy. Let's now talk about the individual life insurance applications. The application is the beginning stage for life insurance. It's the basic source of insurability information. Thus, it is the agent's responsibility to see that the applicant's answers to questions on the application are recorded accurately and all proper signatures are obtained. The three basic parts to an application are the general information part, part 2 is the medical information, and part 3, the agent's report. So the general information asks general questions about the proposed insured, including name, age, address, birth date, sex, income, marital status, and occupation. Also, it will indicate the following details about the requested insurance: the type of policy, the amount of insurance being requested, the name and relationship to the beneficiary, past and present life insurance policies, and additional applications that may be pending. Part 1 will also include information concerning alcohol use, drug use, hobbies, foreign travel, and personal habits such as smoking. Part 2, the medical information section of the application, focuses on information about the applicant's medical history, present condition, and any medical visits or surgeries in the past few years. Other information might include a family medical history and the causes of death of any family members. If the agent knows that a medical exam will be ordered, some agents leave that portion of the application blank and leave it to be completed by the medical examiner. A photocopy of Part 1 and Part 2 of the application becomes part of the insurance contract. In other words, when the policy is delivered to the customer, Part 1 and Part 2 of the application are copied and made part of the contract. Section 3, Part 3, is the agent's report. Part 3 of the application is often called the agent's report because this is where the agent reports his or her personal observations and remarks about the proposed insured. The agent provides first-hand knowledge about the applicant's character, the background and purpose of the sale, and how long the agent has known the applicant. The agent's report does not become part of the contract or part of the policy. Let's look at a non-medical application. If a policy is issued based on the application alone, this is called a non-medical application. Non-medical does not mean guaranteed issue. It means that the underwriter decided to issue based on the information in the application alone. The underwriter may still request a medical exam to clarify information, and the following are facts on your exam about a non-medical app. First of all, non-medical app, there are health questions that have to be answered. The underwriter can still request a physical exam or go for other underwriting sources. The underwriter can still reject it. It's not available at all ages, and the policy does have a lower face amount. Let's now talk about signatures. Each application requires the signature of the applicant, proposed insured, and the policy owner, if different. If the policy owner is to be a firm or a company or a corporation, one or more partners or officers other than the proposed insured must sign the application. The agent signs a form attesting that a disclosure statement has been given to the applicant. Moreover, a form authorizing the insurance company to obtain investigative consumer reports or medical information from investigative agencies, physicians, hospitals, or other sources generally must also be signed by the proposed insured and agent as a witness. Most insurers allow information to be corrected on the application with the written consent of the applicant, which normally means the applicant's initials the changes. The insurer can only assert misrepresentation by the applicant if the application is attached to the policy. By the application being part of the contract, it becomes part of the consideration for the contract, and material misrepresentation made by the applicant can be used by the company in denying liability, seeking reformation, or voiding the contract or rescinding the contract. So this is why the contract is made copy part of the contract, the application, because if you've lied on some part of the application during that first 2-year contestability period, if there's a death claim, the insurance company can review the application again. If they discover the error, they can deny paying the claim. Let's talk about an entire contract. Entire contract provisions address validity of the contract. It provides that the policy itself and a copy of the application, Part 1 and Part 2, if a copy attached to the policy, riders, and any amendments, legally constitute the entire contract between the parties. This clause protects the policy owner in that no company rules, oral understandings, or the like have any bearing on the contract unless included in the policy or the attached application. The attachment of the application protects the insurer in that the application becomes part of the contract, and any material misrepresentation made by the applicant can be used to deny a claim, void the contract, or rescind it within a certain period. And that's usually the first 2 years, the contestability period. Let's now talk about conditional receipts versus binding receipts. In the class of life and disability insurance, insurers do not issue binders. Binders are temporary contracts that are issued in lieu of a policy and used mainly in property casualty insurance or auto insurance. When the applicant pays the initial premium with the application, the agent will provide the applicant with a receipt for the initial premium. The effective date of coverage will depend on the type of receipt issued. Now, this is for life insurance. On the other hand, if a premium is not paid with the application, the policy will not become valid until the initial premium is collected. So there's various types of receipts in life insurance. A conditional receipt for the first premium, which states insurance will be effective on the date if the company accepts the risk as applied for. The insurance company usually imposes a limit on the amount of coverage provided under the conditional receipt. And there are 2 types of conditional receipts. One, the conditional insurability receipt. Coverage is effective if the applicant is insurable on the date the application was made and the required medical exam is completed, whichever is later, and only if issued as applied for. And the conditional approval receipt, coverage is effective only after application has been approved by the insurance company. These types of receipts are rare. Of the 2 conditional receipts, the insurability receipt provides the longest protection, and a receipt that contains the word if is a conditional receipt. Now let's talk about a binding receipt, sometimes referred to as an unconditional only, binding only receipt. Coverage is effective as of the date the application, regardless of whether the applicant is insurable or not. Coverage lasts for a specified period of time. Due to the fact that life and disability products have medical questions, binders are not allowed when the agent takes an application. Temporary insurance agreement. A temporary insurance agreement provides the applicant with immediate life insurance coverage while the underwriting process is taking place, whether or not the individual is insurable. It is another way for an unconditional binding receipt to be put in effect. However, there is a limit to the amount of coverage provided and the length of time it covered is provided. These are somewhat confusing. In property casualty, we call binders an immediate binding of coverage. In life insurance, they're called conditional receipts. The temporary insurance agreement is the most common one, and it basically asks 3 have you been in the hospital any time in the last 2 years? Have you been off work more than 2 weeks in the last 2 years? Are you currently sick and can't get out of bed? You answer no to these serious health questions, and you collect money. Oftentimes, a certain amount of the policy will be immediately effective up to, say, a maximum of $150,000. So even though you sold a $500,000 life policy, if the answer to those serious medical questions was no, and you collected the first month's premium, there's a $150,000 in life insurance immediately in effect. If the insured dies the next day, the insurance company would pay the claim. That's called a temporary insurance receipt. Let's move on to life insurance policy disclosures. There are requirements set in the California Insurance Code if insurance companies and agents use illustrations, spreadsheets, to document the performance of the life insurance policy. Illustrations were discussed back in the general insurance sections, but in order to protect consumers, legislation was passed to ensure that illustrations did not mislead the purchasers of life insurance and to make the illustration easy to understand. This was done by mandating illustration format that was to be used by all companies, specifying the disclosures that must be referred to in connection with the life illustration, and the elimination of footnotes. Companies used to put hundreds and hundreds of footnotes, which were very small print on the last page, which nobody read, and it was very confusing to the insured. Now you can't use footnotes. The basic rules are that insurance companies must notify the insurance commissioner of any policy they're going to use with an illustration, and a policy form on the illustration must be used to identify the insurer. The name of the insurer must be listed, the name of the business, address of the producer, the name, age, and sex of the proposed insured, unless it's a approved composite illustration, underwriting or rating class used, like preferred, standard, or substandard, regarding their health, the generic name of the policy, the death benefit, and any dividend options if they're applicable. The insurer and licensed agent shall not represent the policy as anything other than a life insurance policy. Example, you can't list it as an investment or a retirement plan. It's life insurance first. They can't use non-guaranteed elements in a misleading manner. They can't state that the payment of a non-guaranteed element is guaranteed. They can't use an illustration that's not in compliance, or use an illustration that depicts policy performance in a more favorable way than is produced by the insurer whose policy is being illustrated. You can't show that this policy performs better than it actually does in the real world. You can't provide an incomplete illustration, and you can't represent that the policy payments will not be required for each policy year in order to maintain the illustrated death benefits unless that's factual. And you can't use the term vanishing premium to imply that premiums are paid up or to describe a plan which uses non-guaranteed elements to pay a portion of the future premiums. You can't use an illustration that's not self-supporting or lapse-supported. You can't show interest rates used to determine illustrated non-guaranteed elements shall be greater than the earned interest rates. In other words, you can't show that the interest rate is 3% in your disclosure, but then show a calculation showing 5 or 6% in the actual numbers. The prospective insured or customer must sign the illustration, and during the presentation, copies must be provided to the insurer and the applicant with signatures. Insurers are required to provide the policy owner with an annual report of the status of the policy and notify the policyholder of any changes that would have a negative effect on policy values, and agents must discard old marketing material and only use approved current ones that are in compliance. A basic illustration shall show the date on which it was prepared, have numbered pages, and if the age of the proposed insured is shown, it shall be the issue age plus the number of years the policy is assumed to be in force. Where applicable, the illustration should show premium outlay, guaranteed death benefits, and values available upon surrender. Guaranteed elements should be specifically referred to before corresponding non-guaranteed elements, and the illustration should also show value available upon surrender, policy benefits, riders, or options and definitions of column headings. In other words, it has to be clear to understand what each of the columns mean. If an insurer or agent uses a basic illustration and the policy is applied for as illustrated, a copy of that illustration shall be signed and submitted to the insurance company at the time of the application. Every insurer and agent offering life insurance or annuity contracts to senior citizens with either pre-printed or non-prepared illustrations that contain non-guaranteed values shall disclose on those illustrations the following statement. Big bold type. This is an illustration only. An illustration is not intended to predict actual performance. Interest rates, dividends, or values that are set forth in this illustration are not guaranteed except for those items clearly labeled as guaranteed. All pre-printed illustrations shall contain this notice in 12-point bold print with at least half-inch space on all four sides as part of the document itself or as an attached cover sheet. There's samples of that language in your text. Insurance companies are also required to put out a buyer's guide. The model state law from the National Association of Insurance Commissioners requires that insurance companies and agents provide a prospective insured with written information concerning the cost and benefits of the life insurance policy under consideration for purchase. The information to be provided must be in the form of a buyer's guide and a policy summary. The buyer's guide is written in language that's dictated by regulation and must contain information concerning the appropriate amount of life insurance, a comparison of the costs associated with the purchase of similar life insurance policies, and the various kinds of life insurance policies available to fit the prospective insured's requirements. The policy summary must contain premiums to be paid each year for the initial 5-year policy period, cash values at the end of each year for the initial 5-year policy period, dividends if it's a participating policy each year for the initial 5-year period, and death benefits each year for the initial 5-year period. In addition, the name and address of the insurance company must be listed as well as the insurance policy's generic name. Let's now talk about surrender charges. Surrender charges are fees charged to the prospective policy owner when a life insurance policy is surrendered for its cash value. In other words, you cash out the policy and take out the money. This fee reflects insurance company expenses incurred by placing the policy on its books and administrative charges. It's considered a back-end load charge, and you will find them in universal life and current assumption life policies. The agent must disclose the fact that there are surrender charges and what they are and how long they will apply. In other words, if there's $10,000 in your policy and you have not had the policy long enough to get past the surrender charge period, if you cancel the policy, you may only get back $7,000 of the $10,000 cash value. Many universal life policies have surrender charges for the first 15 years. So in year 16, if you had $20,000 in the cash value and canceled the policy, you'd get it all back. But in year 12, if you had $14,000 in the policy, you might only get back $7,000. Let's talk about the surrender period. Whether it's a life insurance policy or an annuity policy, both have a specified period of time that there will be a penalty for surrendering the policy. It can range from 10 to 15 years, and each year the percentage penalty is reduced. So a cancellation after the first year will have the highest penalty, and a cancellation in year 14 will have the lowest penalty, and by year 15 it disappears. Let's now talk about life settlement transactions. A life settlement is the sale of a life insurance policy covering an individual, typically somebody over 65, who has a limited life expectancy, generally 15 years or less, and who wants to cash out their life insurance policy while they're still alive. The purpose of selling your policy is to get immediate cash to use before your death. And when you sell the policy, you don't get the full policy benefit. For example, if you had a $500,000 life insurance policy and you're 70 years old, you could sell that on the open market and some investor will give you $250,000 right now if you sign the policy over to them. And then when you die, they collect the full $500,000. A life settlement broker is the person who, for a fee or commission, negotiates the sale of a life policy between the policy owner and a buyer. The broker represents the seller of the policy, and of course, the broker earns a commission. A provider is the person or entity who, for a fee or commission, manages the acquisition of a life policy on behalf of the third-party buyer. The provider represents the buyer, and the provider could also be the buyer. Let's talk about suitability possible alternatives to a life settlement. At the time of the application, life settlement licensees are required to provide any applicant for a life settlement contract all the following disclosures in writing and signed by the owner in at least 12-point type. The disclosures include telling them that there are possible alternatives to life settlement, that telling them that some or all of the proceeds of a life settlement may be taxable, that the life settlement could be subject to claims of creditors if you owe money, that might cause other rights or benefits, including conversion rights or waiver of premium benefits that may exist under the policy, to be forfeited. You could limit the insured's ability to purchase insurance in the future because this is still considered a full in-force policy and may disqualify you from buying additional life insurance. And you have to disclose the date on which funds will be available to the owner of the policy. The disclosure document must include all of the following language. You should read this disclosure in your text. It's quite long. You must also disclose that the insured may be contacted by either the provider or the broker or its authorized representative for the purpose of determining the insured's health status or to verify the insured's address. This contact is limited to once every 3 months if the insured has life expectancy of more than 1 year, and no more than once a month if the insured has life expectancy for 1 year or less. In other words, the person who bought your policy has the right to check in to see how you're going. How's it going? Are you sick? Are you in the hospital? Are you about to die? They can check on that every 90 days. And if you're terminal within a year, they can check on it every single month because obviously they're trying to see when their investment is going to produce a profit. So read those disclosures in your text about everything that has to be told to a person selling their life insurance policy. Let's now talk about the owner's right to rescission. The owner has a right to rescind a life settlement contract within 30 days of the date it is executed by all parties and the owner has received all required disclosures, or 15 days from the receipt by the owner of the proceeds of the settlement, whichever sooner. Rescission, if exercised by the owner, is effected only if both notice of rescission is given and the owner repays all proceeds and any premiums, loans, or other money deducted. In other words, if you've sold your policy and you've gotten the money, you have 15 days within which to cancel it and return the money. If you haven't gotten the money yet, you have 30 days to cancel the contract. Let's now talk about insurable interest in life insurance. With regard to life and disability insurance, an insurable interest is based on a reasonable expectation of financial advantage through continued life, health, and safety of another person, and consequential loss by reason of that person's death or disease. An individual has an unlimited interest in his or her own life, health, and safety, and may lawfully take out an insurance policy covering such interest with benefits made payable to whoever he or she pleases, regardless of whether the designated beneficiary has an insurable interest in them. But it's important to recognize that there are 3 rules that are involved. 3 roles that are involved. An applicant, which is the policy owner, the insured, and the beneficiary. The policy owner is a person applying or owning the policy on the life of another, and they must have an insurable interest in the other's life. This means that the applicant or policy owner and insured are 2 different people, and an insurable interest must be established. Insurable interest is based on relationships, which mean an applicant has an insurable interest in another's life that is based on marriage, blood relations, love, affection, or economic dependency. If the applicant is not the insured, that is, a third-party applicant, then insurable interest must exist. If you apply for a policy on another and name yourself as beneficiary, there must be an insurable interest between you and the insured. If you apply for insurance on another and then name someone else's beneficiary, there must be insurable interest between that beneficiary and the insured. In other words, I can't take out a life insurance policy on you. I have no financial interest or no insurable interest in your life. However, if you're my child or my spouse or my key employee at my business, I have an insurable interest and I could take out a life insurance on your life. If the applicant is the insured, then they can name whoever they want as their beneficiary, whether or not an insurable interest exists. Remember, everyone has an unlimited insurable interest in their own life. A beneficiary, if the policyholder is the insured, then the beneficiary does not need to have an insurable interest. So if the policy owner is also the insured, I own a policy on my own life, then I can name whoever I want as the beneficiary, and they do not have to have an insurable interest in me. For example, I could list my church as the beneficiary, or I could list a charity as the beneficiary. If the applicant policy owner applies for insurance and names someone else as beneficiary, there must be an insurable interest between the beneficiary and the insured. So let's see that again. If the applicant or policy owner applies for insurance and names someone else as beneficiary, there must be an insurable interest between the beneficiary and the insured. If there's an insurable interest between the insured and the beneficiary, then the policy owner doesn't need to have one. So that is confusing, but you need to read that in your text and make sure you understand it. If no insurable interest existed between the applicant and the insured at the inception of the policy, the contract is not valid to begin with. And as such, the insurance company can contest the policy at any time. This creates a problem when life settlements are not properly transacted. Let's now talk about identities, life insurance policy identifying. There's types of information recorded on the policy specifications page. The first page to appear on a life policy is the title page, also referred to as the face page or data page. It contains a summary of the coverage and benefits that the policy will provide. The following are also contained on this page: the policy number, the issue date, the type of policy, the amount of coverage, the amount of premium and premium due dates, the name, age, gender, and policy owner of the insured, signatures of the secretary and president of the issuing insurance company, clauses required by law to give the insured information on his or her right to cancel, warning to the insured to read the policy carefully, terms of the policy, its effective and termination dates, renewability of the policy, and optional policy provisions and riders, and the premiums for each rider. There is no such thing as a standard life insurance policy. Unlike property casualty policies, where an independent source develops a uniform or standard contract, each life insurance company writes their own life and disability contracts. However, through state regulation and the adoption of NAIC guidelines, lots of these policies have many similarities. Let's talk about premium payment mode in life insurance. Premium mode refers to the frequency of premium payments. Premium payments can be made in full. This allows the option to pay one lump sum payment with no other payment due during the policy period. You can make annual premiums. This option requires payments once a year. You can make semi-annual, twice a year, quarterly, meaning every 3 months, or monthly. This option could be the direct payment with a check every month. Or you can do bank check plan or electronic funds transfer, whereby payments are automatically deducted from your checking or savings account. And for test purposes, monthly payment means a coupon book and therefore is the most expensive method of premium payment, and annual is the least expensive. The idea here is that if the insurance company gets all their money up front, they have a longer period of time to invest that money, therefore making more interest. So when you pay up front, your premium is cheaper. If you're paying monthly, and the insurance company doesn't get to use that money until it's paid each month, they earn less interest, so therefore they charge more. But don't get confused between monthly payments and BCP or EFT payments. A monthly payment means you get a bill in the mail, write a check, get a bill, write a check, get a bill, write a check. Bank check plan means you might get the bill, but it automatically is deducted from your checking account every month. You do not need to write a check. That is the most expensive because you're paying monthly. And again, as I said earlier, the insurance company doesn't have use of your money all at once up front. Let's talk about policy delivery. All insurance companies are required to deliver a life insurance policy to the owner of the policy in order to start the period running during which the owner may exercise any statutory right to return a policy for cancellation, the free look period. Delivery may take the form of any one of the following methods: registered or certified mail, personal delivery by the agent with a signed written receipt of delivery, first class mail with a signed written receipt of delivery, or other reasonable means as determined by the commissioner. If an insurance company does not deliver a policy by one of the above methods, then the burden of proof shall be on the insurer to establish that the policy was delivered in the event of a dispute with the owner of the policy. It's best practices to always have proof of delivery, and most agents deliver this personally with the signed receipt form signed in their presence and a copy retained in the file. When the initial premium is not paid with the application, some insurance companies require the agent to sign a transmittal notice on the date the policy was delivered and the first premiums paid. The policy owner must also sign a verification of delivery and that the insured has not seen a physician with regard to any illness or injury since the date of the application. If the insured is rated, the agent must have a delivery receipt signed when they pick up the additional premium, and the insured must sign a statement that their health has not changed. That concludes this section